Hey guys, TommyBryson here, and today I'm going to give you guys a full-blown tutorial on how to buy an investment over at Vanguard. But more importantly, I'll tell you exactly how I invest, and on top of that, the difference between an ETF, a mutual fund, or also, for example, an index fund. So today I'm basically going to tell you everything I wish I was taught in my 16 years of schooling in the US, okay? I went to high school, middle school, elementary, also college, but no one ever taught me any of this right here. And today, I'm going to give you guys all the information I know. That way, you walk away from this video with all the tools you need to go out there and start investing if you actually want to. And if you want to copy me and do exactly what I do, also, I'll give you guys all my secrets on how I actually invest. And by the way, guys, if you guys are new here, I post videos every single day, so make sure to also subscribe and hit the bell so you're notified. And on top of that, also destroy the like button. Now, the very first thing I do want to say is this, guys, okay? When it comes to investing, it does not matter how much money you have. It's all about investing consistently over a long period of time. Now that we got that out of the way, let's get into exactly, Tommy, what is a mutual fund? What is an index fund? And also, what is an ETF? And can you break it down for me in less than 1 minute or 30 seconds? The answer is yes, of course I can, okay? Of course I can. And here it is, okay? An index fund is a type of mutual fund. So the most important thing to break down is basically what exactly is a mutual fund. A mutual fund is a fund that is actively held by managers, okay? And these managers have one goal with your money, which is basically to grab your money, a lot of money actually from different people, create a fund, but that fund and those managers have one job. And that one job is to go out there and try to beat the market. So if the average return of the market is 7%, every year they want to go ahead and say, well, we're going to do 8% or 9% or 11% or 12% because their job is to basically go out there and beat the market, and that's why you pay them. Now, by doing this, they're constantly selling and buying and getting you taxes and charging you extra money and fees. So the answer is, think about a mutual fund as an actively held one trying to basically go out there and beat the market. Well, on the other hand, an index fund is what I have and what I love, okay? An index fund, you're not trying to beat the market, but instead own the entire market and basically track the market. Because again, an index is just trying to track the performance of something. So in this case, okay, let's say I told you, hey, I want to basically track the performance of all the tech stocks in the United States of America. What would he do? I would basically just buy all of them, and that way my portfolio, my collection of stocks, would basically give me the underlying index of that entire market right there. That is all an index fund is. Now, because index fund managers are not constantly buying and selling, they're just holding, okay? They just hold and hold and hold. It means you don't have that much taxes, you don't have that many fees, and you don't have to worry about all those trades. And by the way, the average mutual fund does not beat the market. So in reality, it's kind of like, why would I pay you to do something that you're not even gonna do? So it's best to always just own the market and track the market, and that way you get the return every single year. And it might be off by 1% on average, just like 1%, that's about it. But usually you're gonna be tracking the market overall. Now, lastly, Tommy, I get that. Mutual fund actively, index funds passively, but what about an ETF, okay? I heard about that stuff. Well, an ETF is just an electronic traded fund. By the way, sometimes I can't believe all the things I know. And by the way, I'm not a genius. It's just basically the more you learn, the more you practice, the more things you go out there and you learn and you educate yourself. And before you know it, you know exactly all this stuff just like I do. Now ETFs are basically traded in the stock market, which basically means the price is not based on the underlying assets and the true value, usually like mutual funds and index funds. In reality, they're based on supply, also demand, and also public perception. So although an ETF might be worth X amount, it might sell for more or it might sell for less, but you get a price every single minute while the market is actually open. While mutual funds and index funds only give you a price maybe like twice or 3 times a day, and that is about it. And they sell based on the underlying assets value, okay? While ETFs are selling constantly at whatever price the market has it listed for. And that's the main difference. And by the way, ETFs are very cheap because basically you can buy them partially if you want to. And on top of that, they don't have that much of high expense ratios. Now, this is something you're going to hear over and over and over again if you're going to invest into index funds, mutual funds, or for example, ETFs. Expense ratios is the cost of operations of those funds, and they basically make sure you pay for it. So you want to have an expense ratio always less than maybe 0.50%. Okay, anything higher than that usually is way too high. And by the way, some actually out there charge around 1% and sometimes even 2%. That stuff is way too much money. So an expense ratio is the cost basically to manage that entire fund. And basically index funds charge very low, ETFs charge very low, while some actively held mutual funds charge a lot of money. And by the way, this is not my middle finger, okay? I just want to clarify that. But however, guys, now that we know exactly an index fund, a mutual fund, and also an ETF, let's break down exactly how you go on Vanguard and actually go ahead and buy one of these investments. Again, I'm going to tell you everything by the end of this video right here. All you have to do is basically, here we go, guys, okay? I'm on the page right now, but I just want to go back fully. That way you guys know exactly how everything works. Just type in on Google Vanguard and click right here where it says Vanguard Mutual Funds. Now it's gonna pop up with this lady. Sometimes it's an old guy or another girl. It doesn't matter. Look, there's this guy I'm talking about. Okay, this guy is kind of weird, but that's not what this video is about. But this guy is kind of weird too. Now what you want to do is go down here where it says Personal Investor and click it. Okay. And then it's going to pop up with this other old guy right here, or for example, an old lady, or for example, somebody else, okay? And you want to create an account, just open an account up, and that is about it. Now, once you open an account up officially, you can go ahead and start browsing ETFs, mutual funds, and also index funds. However, you don't have to have an account to browse what they actually have. It's kind of go into a store and be like, hey, I want you to buy before you see. No one does that. So all you have to do to browse is basically click invest in right up here and go to Vanguard Mutual Funds, okay? And by the way, you won't see anything that says basically index funds because again, an index fund is a type of mutual fund. So it will be here in this category. So just click, for example, Vanguard Mutual Funds. And then you want to click, for example, here where it says browse Vanguard funds by asset class. Well, not that, all right? Yeah, that's fine, actually. And it's going to show you around 132 different mutual funds that they actually offer at Vanguard. Now, although this is great and you're going to see all of these options, you're probably going to say, Tommy, but what if I just want to hold passively and I don't want to worry about active funds and I don't want to see that? In reality, all you have to do is just click right here where it says filter, click filter. By the way, Vanguard should tell me, hey, Tommy, good job with this tutorial, okay? Because they don't actually do this themselves. Now, what you want to do is click where it says management. Again, active management is more expensive. Mutual funds trying to beat the market. Passive management is index, okay? Because basically you're trying to track the market. In this case, all I want to see is just index, okay? Passive. I'm going to go for around 132 funds. Look how much it's going to go down to, guys, okay? It went down to around 62 mutual funds, and that is about it. And these are all index class, okay? That's all it is. Now, I want to show you guys all these right here. Great, great, great. These are all the funds you can go ahead and invest into. However, look at this right here, guys, okay? I actually invest into this one right here. It's called small cap. And here it is, guys, right here. Now, this investment right here is basically into small cap index funds. I have this investment myself, okay? However, that's not the point here. I want to show you guys something that you guys are probably not going to like. If you want to buy mutual funds or index funds in Vanguard or even ETFs, you have to pay the full price for the investments. On top of that, if you're going to buy mutual funds and index funds, there is a minimum to start investing into them. In this case, the minimum investment is around $3,000 for this entire index fund right here. It's very expensive. Now, guys, I want to mention one thing also. Me, myself, I have around 7 different investments in my portfolio, in my collection of investments, okay? In this case, okay, if I have 7 investments and the minimum is $3,000 to invest, in this case, it would take me around, just start investing, around $21,000. And that's why usually I don't like investing directly with Vanguard because basically it's really expensive if you don't have that much money because of the minimums, okay? But if you want to invest with them, just make a savings goal, save up for it, and then start investing. But it can be very, very expensive, okay? Now, there is one more thing you guys need to know about. Again, the expense ratio for this entire fund is around 0.05%. By the way, let me zoom in here just so you guys can actually see here, okay? The expense ratio is 0.05%. The entire minimum investment is around 3,000. And by the way, whenever you want to see the ETF version of any mutual fund, just click right here where it says ETF, also available as an ETF. It's always below the title. Click it and it'll show you exactly what the ETF actually is. In this case, it's actually VB, and I also own that ETF right there. And if you scroll down, it'll tell you, for example, hey, expense ratio is 0.05% also, which is also pretty cool. And there is no minimum invest either. And that's why usually I like investing with ETFs. Very cheap to actually own. Now, let's go back here because there is something I want to show you guys, okay? I'm going to have to go back to not being this big here, okay? Now, let's go back to this filter, okay? I showed you the small cap index fund, okay? And the expense ratio was 0.05%. And here it is right here, just so you guys actually remember. But if I click filter and I go from index to actively held, trying to beat the market, by the way, the average one does not beat the market. Just want to get that into your head. Just click see funds here. And if I scroll all the way down again to basically small cap right here, small cap growth stock, great. Let's click this one right here, explore. And I'm going to zoom in just so you guys can actually see here. Look at this, okay, guys? Small cap, great, great, great. But look at this. A minimum invest of around $3,000, and also the expense ratio is around 0.45%. That is 9 times more expensive than my normal index funds, because basically these people are trying to beat the market, and that's why it's so expensive. So overall, if you wanted to go ahead and buy this investment, all you have to do is basically just click right here where it says buy. You click buy and you open up an account. Just start a new account, and that is basically it, guys, okay? The easiest part about investing is always going to be going ahead and buying. The hardest part is knowing what to buy and why to buy. So now, so far we covered exactly index funds, mutual funds, ETFs, how to explore on the entire Vanguard website, how to buy on it, how to open up an account. However, now I want to tell you exactly how I go out there and invest and what I actually invest into, okay? Now, guys, this right here is based on my portfolio that I actually have in my entire Vanguard account, okay? Now, I want to be 100% honest here. The only reason I own Vanguard mutual funds and also index funds is because basically this portfolio right here is for my retirement account, and my company pays for all this stuff. It's for tax purposes, and it saves me a ton of money. But as an individual person, usually I wouldn't do this because basically it would be very expensive to actually have. And by the way, I only have around $10,615 a year in my retirement, but I want to show you guys exactly my entire mix of investments, okay? And here they actually are. Now, all I have to do is click my account and click balance and holdings, and here is going to pop up. There you go. And here is basically what I invest into, guys, okay? Again, I told you I invest into 7 different investments, and here they are right here. I'll zoom in if you guys want, take a picture of it, but I'll show you guys exactly how to do this also later on in the video. And this is basically what I invest into right here, all of my investments, and also the expense ratios and how much money I actually have in them and all that stuff, okay? This is basically my entire individual 401k and also my Roth 401k, but basically I invest into the exact same thing every single month. And I just started this literally last month, October, okay? However, guys, like I said before, index funds and mutual funds are very expensive to actually own. So me personally, as a personal investor just like you, what I have is basically M1 Finance, okay? And with M1 Finance, I invest into ETFs that do the exact same thing as my portfolio over at Vanguard. Now, these investments right here are 7, the same 7, just in ETF format, except these 2 right here that belong not to Vanguard, but actually to BlackRock. But that's another video for another time. But I want to break down 3 things I'm doing in my portfolio and why I invest the way I actually invest, okay? And by the way, guys, right now, I'm up around almost 8%. Don't worry about that because basically, again, the stock market goes up, goes down. I don't care about it. I care about the long term. Just last week, I was down around 5%. Today, I'm up around 7%. It doesn't really matter. It's all about the long term. But here are the 3 things I'm doing when it comes to my portfolio. The first thing is basically, I'm very well diversified, okay? And by the way, If you're saying, Tommy, I want to invest this way, the answer is I have a link down below to this portfolio. That way, when you click it, you can go ahead and invest into it with M1 Finance, or for example, just copy it over into any Vanguard portfolio that you actually want to invest into, okay? That's the whole goal here. Now, my portfolio has US investments, outside the US investments, small cap investments, also corporate bonds, treasury bonds, real estate investments, and also emerging market investments. This is basically a portfolio collection of investments that's very well diversified, both in the US, outside the US, into different markets. That way, I don't carry that much risk. And this is why I invest the way I invest. And by the way, all this right here has certain targets. So the US investments obviously carry a lot more of my portfolio, around 38%, outside the US, 16%, small cap, 14%, 10%, 10% for bonds, and then 8% for real estate, and then 4% for emerging markets, which is basically very risky. I want to be diversified. That way, I don't carry that much risk, and this is why I invest the way I invest. However, there is one more thing I'm actually doing here. Tell me, how often do you actually invest, okay? In this case, I do something called dollar cost average. It basically means every single week, I invest the same amount of money every single week, no matter what. Why? Because basically, if I buy high and low every single week, by the end of the year, I'm going to basically buy the market average. That way, I don't worry about buying way too high or way too low. So I highly recommend, if you want to invest the way I invest, with either, for example, Vanguard or M1 Finance, make sure you do dollar cost average and you buy the same amount of money in those investments every single week. And by the way, with M1 Finance, you only need $20 to $25 to actually start investing and invest right here. While in Vanguard, I would need around $21,000 to invest in this portfolio right here. And that's why, again, I prefer to invest into ETFs, again, with M1 Finance. Now, the last thing I'm doing is called compound interest, which is basically the time I give my investments to actually grow. In this case, guys, okay, this portfolio gives me around 8% every single year on average over the next 30 years, okay? Now, if I use a compound interest calculator to compound exactly how much money I'd actually have, well, in reality, let's say I started out with $0. And I'm going to add $500 every single month to my portfolio, which is around $6,000 every single year. I'm going to give it 30 years to grow at an 8% return every year, plus 2% for dividends, because again, I also reinvest my dividends. In this case, I'm looking at around 10% every single year instead of 8%. Well, I'm looking at around $1 million by the end of my investments, okay? However, if I did 12K, $1,000 every single month, okay, in this case, I would have around $2.1 million. And that's the cool thing about investing. If you give your investments the time they need to grow, you'll be good to go. If you diversify, you won't carry that much risk. And if you buy every single week the same amount of money, you won't have to worry about, hey, trying to time the market. It's impossible to time the market. If the market crashes right now, I buy more at a discount, but I'm never trying to basically go ahead and time the market. That is not a good idea. But guys, overall, that is all I have for you guys today. Hopefully, this video taught you everything you need to know about investing with Vanguard and also into ETFs and index funds and mutual funds. And by the way, again, link down below to my portfolio and exactly what I actually invest into. And guys, I'll see you guys next time. As always, like this video if you liked it. On top of that, also subscribe and hit the bell so you're notified. And before I go, if you want to text me or talk to me, start my Patreon link down below or send me a DM on Instagram at TommyBryson. And if you watch a video on basically different portfolios to invest into based on your risk tolerance, here's a video right here. I'll see you guys tomorrow. Thanks for watching, and as always, guys, peace.